How government spending fuels inflation. All right, my man Rich from Missouri sent this to me, and I've been following Tuco for many years. I don't follow the Wall Street Journal anymore. I just don't care. But we're going to talk about this. When debt grows so much that people don't believe the Treasury will pay it, they sell their bonds and buy other things, sending prices through the roof. What? They sell their bonds. All right, so they're selling their bonds, they're sending the bonds prices through the roof at the same time, or are they sending other things prices through the roof? That doesn't make any sense. I know what he's saying. He's basically saying when people don't think that government's going to pay their debts, they're going to sell their bonds and use that money to buy other stuff. Okay, is that what happened? That's just so freaking silly. I just can't take it. All right, I'm not going to read you the whole thing. I want to read you some... let's see. So we got the inflation. January is the highest since '82. We know that. Let's see. The current economist John Cochrane says it came as a complete surprise to the Fed. All the governors who reported forecasts missed it, and he calls it an institutional failure. All right. He parses the president inflation in conversation with Zoom, where he's a senior fellow at the Hoover Institution. Okay, hold on just a second. He traces the president inflation to the pandemic and the government's response. The Treasury issued $3 trillion of new debt, which the Fed quickly bought in return for $3 trillion of new reserves. They then sent checks to people and businesses, later borrowing another $2 trillion and sending more checks. Overall, the Fed debt rose nearly 30%. Is that all a surprise that a year later inflation breaks out? All right, so the Fed debt rose 30%. What was the Fed debt before? What, $25 trillion? And that doesn't include the unfunded liabilities of the big three, Social Security, Medicare, and Medicaid. So if you listen to Kotlikoff and others, they say our unfunded liabilities are $220 trillion. If there's anyone out there who thinks the Fed is going to pay their debt, I don't know where you've been for the last basically since the late 60s. Where the hell you been, man? Not paying off the debt. It'll never happen. It'll never happen. If you think just because now they're not going to pay off the debt, I don't know what to tell you. The idea that you're selling your bonds because you don't think the Fed's going to pay the debt. Let's take a gander, shall we? Because that would make sense, except for the fact. Oh, let's see what we got. We're going to look at the 10-year Treasury. Going back to 1984. That's the yields, which means the price have gone up. The price have gone up. Now, let's just say year to date. Oh, my goodness. Look at that. The Fed's not going to pay their debt. They're going to sell other bonds. And yet the yield has actually gone from, 1.6 to, what is it now, 1.9. All right, so 30 basis points. That's not a huge jump in yields, which would, the corollary to that is a huge drop in prices. All right. So again, we talk about Freeman. We talk about the helicopter flying over an island and dropping money. I hate that. It's such a silly argument. People are spending the money, driving prices up. All right, well, I mean, there's some, look, I don't deny that, but that would be transitory for sure. I don't deny that when people have more money, they spend it. The question is, will that continue forever? The answer is no. It's just not going to happen, man. Let's see. The intellectual failing showed up first in the recession that followed COVID. The economy didn't need demand-side stimulus, he says. It's not 1933 again. The pandemic is, like the economy, a huge snowstorm. Sending people money won't get them out to close bars and restaurants and airlines and businesses. Interesting. There's a new book coming out, which is called The Fiscal Theory of the Price Level. It's a challenge to monetarism, which is Milton Friedman. All right, the theory of monetarism, the theory of controlling money is a chief method of stabilizing the economy. It's just silly, man. The new theory holds that when the overall amount of government debt is more than people expect the government to pay, we see inflation. The U.S., how does this work? The government has $20 trillion of debt outstanding. That means over the long run, people expect taxes to exceed spending by $20 trillion to repay the debt. But if they think the government will only be able to pay back $10 trillion, they'll get rid of their government debt fast before it is worth less. They then try to sell it in order to buy other things. That keeps going until all prices have doubled until the $20 trillion is only worth $10 trillion at today's prices. Why hasn't fiscal inflation happened sooner? After all, the government has been borrowing money like the proverbial drunken sailor for decades. And this he says, inflation comes when government debt increases relative to people's expectations of what the government will repay. I mean, can you? If the Treasury borrows, but everyone understands it will later raise tax rates or cut spending, the debt doesn't cause inflation. Oh, so isn't that interesting? So basically, it's not government spending that causes inflation. It's people's reaction to government spending. Got it. Well, that's okay. So what is it, right? So we're at 20 trillion debt. Oh, we expected to pay back 21 trillion. No, sell your bonds. We're going to go broke. It's just freaking stupid, man. I'm not saying this guy's stupid. I'm just like, I'm going to share with you something else here that no one knows. That's the thing. All right, let's see. Hold on a second. Rates can't go up very much. The government, or let's see, any increase in interest rates raises the interest cost of servicing that debt. The biggest debtor in the world is our own government. Any increase in rates, they're going to cost more. The government must pay those higher interest costs by raising tax revenues and cutting spending, or by credibly promising to do so in the future. 100% debt to GDP. He says 5% higher interest rates mean that an additional 5% of GDP, or $1 trillion, for every year that high interest rates continue. We don't have $1 trillion sitting on the side to pay a 5% increase of higher rates. We just don't. It's not there, man. If we're having inflation because people don't believe the government can pay off the deficits it's running, and it will not reform the larger entitlement promises, and people won't believe the government can pay off an additional $1 trillion of deficits. Yeah, right. And I completely agree with this. Inflations do not happen to growing economies whose governments run things well in flush treasuries and with flush treasuries. Inflations do not happen, and we're talking what we're dealing with right now. Historically, inflations have always come to countries in trouble, primarily fiscal trouble, the Congress, the tax and spend trouble. But fiscal trouble is caused by bad economic policies, 100%. Revisit what I've always said. Inflation is a supply issue. What happened? Why didn't the Fed see that the massive stimulus would cause inflation? Hey! The Fed's modeling and understanding of supply constraints is very simplistic. It focuses only on unemployment as a measure of slack in the economy. Pablo, stop. There's no group of analysts at the Fed measuring how many containers can get through a port. The Fed and its larger intellectual circle of economists don't think about supply at all. All the variation in the economy to them is basically demand. 100%. So I'm going to show you something else. An article from Bloomberg with Tyler Cowen, let me get back to the whole stuff. Tyler Cowen piece from Bloomberg, which I access it through Advisor Perspectives. And even if you're not an advisor, you should be signing up for Advisor Perspectives. Some of the best writing in this kind of stuff that's out there for sure. All right, so he says inflation will be exactly what people expect it to be. And I chuckle at that, because what did people expect it to be in 2008, 9, 10, Tyler? I mean, they expected it to be high. All right, so sometimes yesterday's ideas, crazy ideas, turn out to be sane or even essential. For instance, Fisher Black, the late economist and co-discoverer of modern options pricing, argued that the rate of price inflation will be whatever we think it is. Okay, well why do we need economists? They serve no purpose, man. So he said if inflation expectations are high, it'll be high. If inflation's expectations low, it'll be low. And he said this was always true. Right, that's just silly. So plenty of people like to say that they knew at the time that the big money supply increases of 2008 and 9 were not going to lead to high inflation. There are also many people who like to say they knew at the time the combined monetary and fiscal response for the pandemic would lead to higher prices of inflation. Relatively few people can gloat about getting it right. I'd like to know who these people were that said there wouldn't be high inflation in 2008 and 9. Because if inflation is too much money chasing too few goods at all times, like Friedman said, then you cannot be a Friedmanite and say that it was not that spending was not going to be inflationary. You just can't. You can't do that. Now, if you're an MMT person and you say inflation will put the brakes on once inflation is out of control, well, you're wrong here too, because you weren't able to predict this, and you gotta put the brakes on now. Stupid. Let's see. Paul Krugman has argued that there was not high inflation after 2008 because the U.S. economy was in a liquidity trap. All right, so when did he argue this? So let's take a look. He argued that in 2013, but I can almost assure you he wasn't arguing that in 2008 or 9. We can look. You can look. I don't care, but I can almost assure you. Liquidity trap. There was no liquidity trap after they got rid of mark-to-market accounting. Now, balance sheet recession, a la Japan, sure, but liquidity trap, no. Now, what you can make the argument? Well, the banks weren't loaning money. There's tighter lending standards. Same thing happening now. Yeah. Let's see. Black's rejoinder to the Keynesians was a subtle one. We're always in a liquidity trap, and I kind of agree with that. Says bank, I don't care about that. One argument is that the different this time because the U.S. government engineered a major fiscal response to the crisis, not just a monetary response. Maybe, but if you focus on the fiscal side, i.e., they sent the rebate checks or whatever they're, what the hell they call those? The Harper? No, that was Obama. Whatever they call it, the stimulus checks. All right, they sent the stimulus checks and those are done. So, like Tyler says, then you'll be strongly on team transitory because the fiscal response now lies firmly in the past. So the inflationary pressure should be subsiding. I can't say that view has been refuted. Who knows what next month will bring, but it looks less likely. If anything, the data are showing inflationary pressures being transmitted to more sectors of the economy. All right, let's see. Have you ever wondered why a country such as South Korea had inflation as high as 19% during the growth years? Exactly. That's the thing the other guy said. There wasn't much inflation in high-growing economies. It's just not true. None of these people know what they're talking about. Doesn't mean they're lying. It just means there's a data for, like, I think it was Truman who said, I just want a two-handed economist, or one-handed economist. That's what we say. I want a one-handed economist, because economists say, well, it could be inflationary, but on the other hand, yeah, I just want a one-handed economist. I don't want the other hand. 100%. In general, high-growth countries often have high inflation, which goes exactly against what the other guy was saying. Crazy. Who knows? But see, they're both saying the same thing, except they're both saying it from wrong data sets. Why do you trust economists, man? Jeez Louise. High inflation, high growth. Moderate inflation, high growth. But they're all saying inflation is based on expectations. It's freaking nuts. Nuts. Ah! I can't quite bring myself, let's see. Another idea is a suspect is a notion that the Fed can steer rate of price inflation as it chooses. They can't, man. It's just stupid. Let's see. Market expectations for inflation have recently turned up sharply for the 1-year horizon into the 3-year horizon. They still stand above 3. Let's see. I can't quite bring myself around to the Fisher-Black view on inflation. I was brought up believing in a well-defined quantity of money that casually determines the price level, and I still see central banks commanding a lot of attention from the markets. Nonetheless, I no longer see the Fisher-Black views as far from mainstream. All right. If the world as a whole is getting weirder, and it seems to be, then maybe inflation is too. I just can't take it. All right, there you go. No one knows what I'm talking about. You just can't. Look, man, just economist schmonicomist. I'm not say it. I'm from Maine. That's how we talk. We'll see you.